Alright, so we basically call the FRM levels as part 1 and part 2. In the first level, we have got 4 subjects. The first one is going to be your quants. The first one is going to be foundations of risk management. Second one is quants. Actually, I always start with quants. So the first subject is going to be foundation of risk management. In the level 1, you are having approximately 69-70 readings, 70 chapters, and in level 2, part 2, you will be having approximately 79 to 80 chapters. So there are 69-70 chapters in level 1 and 80 chapters in level 2, which is divided into 4 subjects in level 1 and 5 subjects in level 2. I'll give you a brief idea of level 2 as well, because you need to take a call as to, you need to have an idea as to what you're studying. You need an overview of the syllabus. When you're looking at financial foundations of risk management, you're going to be looking at topics like what is risk management. It is going to be a mix of theory and it is going to be a mix of portfolio. So there are basically 2 major chunks when you're looking at the level, the book 1 part of it. Foundations of risk management, what is risk? There are various kinds of risk. Say suppose an asset is illiquid. Suppose I want to sell a share. If there is a 500 rupees share that I have, I will be able to sell the share at 500 rupees in the market. But if I have a house which is, let's say, worth 50 lakh rupees, if I want to sell the house at 50 lakh rupees in the market, I will not be able to sell it immediately at 50 lakh rupees. If you want to sell it immediately, you probably will have to sell it at a lower price at, let's say, 45, 46 lakhs or something. If you want to sell it at the fair price, that is 50 lakh rupees, you'll have to probably take a month or 2 or even longer in order to be able to sell it at its fair price. That is known as liquidity risk. How liquid is your asset? Are you able to sell the asset at its fair price in a short duration or not? Credit risk. The bank is giving loan to someone and the person is defaulting on that. So that risk is credit risk. I buy a share or I've bought bonds, debentures. The interest rate in the market is going up or down and accordingly my share prices have moved up or down. That is market risk. Because of market factors, you are facing that risk. And I've just started with it. There are multiple different varieties of risk, which is what we cover in the Foundations of Risk Management first chapter. What is risk all about? Then, instead of having every single, like say for example, you're talking about a bank. Now the bank could be having multiple departments. There could be a credit card department, there could be a forex department, there could be a corporate banking department, there could be a retail banking department. So there are multiple departments in the bank itself. Now if each of those departments try to manage their risk separately, don't you think it will create a problem? Because everybody is trying to do their risk management separately. Don't you think it's going to be better if there is a centralized risk management system? Because there could be a lot of overlapping risk. Say for example, the forex department is scared of dollar rising and the credit card department is scared of dollar falling. Just don't concentrate so much on the how and all, because once I start with the curriculum, I'll be able to explain those things. Don't you think that these 2 people can cancel off their risk with each other only? Suppose one department is supposed to get dollars, one department is supposed to give dollars. Don't you think they can cancel out each other? So don't you think that we should have a consolidated risk management system, a centralized kind of risk management system? So those things will be there. Now when you're looking at a company structure, you have a CEO, Chief Executive Officer, you've got a COO at times, Operating Officer, you've got a CFO, Chief Finance Officer. When you're looking at, let's say, a mutual fund or an investment company, you will have a Chief Investment Officer also. When you're looking at an IT company, there will be a Chief Technical Officer also. When you're looking at a banking financial institution or an energy company, you will also have a Chief Risk Officer. So what are the roles and responsibilities of a CRO? How does the functioning of CRO happen? What are the risks that the banks take? A little introduction into the risk management by banks. All those things we'll study. Then you'll study about the financial disasters that have happened already. Lehman Brothers was a financial disaster. We need to study Lehman Brothers so that that kind of a situation is not repeated in the future. We need to analyze as to what were the measures that was taken after Lehman Brothers collapsed. Which measures by the government? So the government took action A, B, C, D, E. So action A, B and C was successful, D and E was a very bad idea. So next time something of this sort happens, you take action A, B and C but not D and E. So you need to study such kind of disasters, financial disasters that have happened in the past, so that it does not repeat in the future. There are a lot of examples, Chase Manhattan Bank, Allied Irish Bank, Sumitomo, and all these kind of 7, 8, 10 case studies or something which we will be studying in a chapter called Financial Disasters. Then there will be a couple of readings which is going to focus on the 2007-8 crisis. Now what happens is, in part 2, there are 5 subjects over here. The fifth subject is called current issues. So the current issues subject keeps on changing every year. The May and November syllabus for any given year is exactly the same. There is no changes. But from year to year onwards, the syllabus changes. Level 2, this subject changes entirely. So a few years back, we used to have the 2007-8 crisis covered over here. But now, in the last year, we were covering bitcoins and algorithmic trading and all, high frequency trading and all, negative interest rate and all. Now we are covering data issues, data analysis, big data, econometric models and all those things. So this subject is very, very evolving on a regular basis. So 2007-8 crisis used to be over here earlier, but now the 7-8 crisis is quite important and we've got a couple of readings on that in book 1. So 2 readings on the crisis we'll be studying over here. Then the data part has become very important. Today the Facebook is absolutely facing a lot of wrath in terms of the data sharing that they have done. So we will do a little small, very easy theoretical reading, to be honest, a little irritating reading on data. So how the data information system and all that management needs to be done. It is very important for professionals like us to maintain a very strong level of ethics in our profession. So we have something called the GARP Code of Conduct. GARP is the institute that is providing us with the FRM designation. They have a code of conduct. We cannot manipulate the client. We cannot try to advantage ourselves. Say for example, a client came in and he told me that our bank is having so and so issues. You cannot go and start selling that bank's shares and tell everybody that the bank is going to do very bad, sell their shares. You cannot do insider trading because that is client information. So there are certain standards, certain principles and ethics that you need to follow. Otherwise, you will not be able to maintain the integrity of the profession. It becomes very, very important. Sorry. The entire banks could fall apart. The entire banks could fall apart. You have to maintain ethics in your designation. So what kind of code of standards and all you need to follow, what ethical responsibilities you have, that is going to be in your GARP code of conduct. Now the questions do not come in very directly that the questions for GARP code of conduct would be in a manner that suppose so and so happened, this person was an FRM and he did so and so, then this client happened, then the bank did this, then this happened. So they'll give you a story in 7, 8, 10 lines or so, and you have to tell whether the violation has happened or not, and if a violation has happened, then of which standard the violation is taking place. So these are the kind of analytical questions you'll be getting. So even if the content is theory, your questions are not going to be easy. The questions are not going to be a direct question, what is the advantage, what is the disadvantage, state 2 reasons, state 5 reasons. It's not those kind of questions that you'll be encountering. The questions will be absolutely analytical, whether the questions are numerical or non-numerical. So questions are going to be very, very analytical. And then there are 3 readings on portfolio. Now what do you understand by portfolio? The portfolio part is going to be calculation related and numerical. The other readings in this particular book are going to be theoretical, as in non-numerical. But the questions are going to be very, very analytical. When you're looking at portfolio, we must hear from our seniors, our elders, that don't put all your money in one place, don't put all your money in one industry, don't put all your money in one stock, one steel sector or something. What happens is, don't put all your eggs in one basket. The logic behind it is that if, say for example, I've put in all my money in Tata Steel, and if Tata Steel goes down, if I put all my money in Satyam and Satyam went down, what will happen? I will not be able to sustain my portfolio. But if I have my money put in 5 different industries, even if 2 industries are not doing so well, there will be 3 industries which is doing well, and they'll balance out my portfolio and I'll get a decent average return. So diversification, that is what you call diversification, having multiple sources of income. So that even if one market is not doing very well, there are other markets which is going to be compensating for the same. So that is your diversification part, right? So that is why we need to understand portfolio. Now what is portfolio? When you combine multiple stocks, all these stocks and shares and bonds and currency and gold and whatever I hold, all my assets taken together, so cumulatively that is my portfolio. What is the return? What is the risk of the portfolio? How should I construct the portfolio? So a little bit of portfolio analysis is going to be there over here in this particular subject. So that is your foundations of risk management. The second subject is going to be quants. Now the one question that I get is, I did not have maths in class 11 and 12, or I'm scared of maths, I don't like maths, I don't understand maths, so will I be able to crack FRM or not? So to give you a very precise answer, 1, of course if you have maths in 11 and 12, it will be relatively easier for you. 2, if you did not have maths, it's difficult, but then you can still manage, because everything that we do is going to start from scratch. Now when you're looking at the quants topics, it is going to be primarily of three parts. One is your annuity, one is your probability, and the other one is going to be your statistics. This is going to be the most detailed portion when you're looking at the quants part of it. Now, even if you, for ISC students, you've done annuity in 11 and 12. For the non-ISC students and the other students who did not have maths, you've not done annuity. Now, when I'm talking about 100 rupees today, if I give you two options, you either get 100 rupees today or you get 100 rupees after a month. Which option would you choose? 100 rupees today. Because if you deposit 100 rupee today in the bank, you will be getting 100 plus something more later on. So, for any calculation with respect to money, when I want to calculate, suppose I'm telling you that you are taking a 5 lakh rupees loan to buy a car. What is the EMI that you need to pay? So there are a lot of numerical interest rate and all those calculations that need to be done. That is going to be covered in annuity. Of course, ISC students with the ISC board, students of class 11 and 12, section C, you've done annuity, you will find it maybe 10%, 20% easier. But the others will be doing it from scratch and we will be doing it absolutely from scratch over here, so it won't be a problem. With respect to probability, you'll have a couple of readings over here. Now you won't have extreme questions of probability, that what is the probability of finding this word in a dictionary and all those things. It's not like permutation, combination and probability to that level. You'll just have the application of probability. Probability also we are going to be doing absolutely from scratch, so you don't have to worry about it. When I'm looking about probability, for those who had probability in 11 and 12, you've done something called Bayes theorem. Now when you're talking about Bayes theorem, if you ask me the formula of Bayes theorem, I don't know the formula of Bayes theorem. But you give me any question of Bayes theorem, I'll be able to solve it. Because you don't need the formula. You want me to derive the formula, I'll derive it. I'll take 2 minutes and I'll derive it for you. But mugging up the formula does not work all the time. Because there are a lot of formulas that's going to be there. But you won't be able to mug up all the formulas. There will be quite a few formulas which I'll not make you learn at all. And you'll be able to solve them using unitary method, class 7. The point I'm trying to make is, for those who did not have maths, you'll find it a little difficult. But then we will do everything absolutely from scratch, so you should not have a problem. If you still have a confusion, first few readings of quants is there uploaded on YouTube. For the live students, you are more than welcome to attend the first few classes. You see the classes, you attend, you understand, you see whether you are going to be able to work it out or not, and then you take a call. I think you can easily take a decision that way. You can spend at least a few classes worth of your time to take a call, right? But honestly, you will not have a problem because we'll cover everything from scratch. So even when you're looking, as I was giving an example of Bayes theorem, we'll just draw a simple decision tree and I'll show you how to do it. You will be able to derive all the formulas yourself. You don't have to learn the formula of probability. I don't know that P, A, this, B and this. I don't know how to do all this. But I'll be able to do all the sums and you will be able to do them as well. We will be able to do all the sums of all these formulas. So you don't need to mug up all the formulas in probability. In case of statistics, now say for example, you would need logarithm, you need index numbers and all, but you don't have difficult questions on log. Your logarithm would require only this much, that if a to the power x is equal to y, log y base a is equal to x. You don't need anything else from logarithm. This much I think I can apply, that much maths you cannot say that I don't like maths. Index numbers, I can do a to the power m to the power n is equal to a to the power mn. So application of index numbers will be used. We are not going to do algebra or trigonometry or calculus or anything. We will not need all that. But at least this much of index number you have to let me apply. You can't say that I don't like you. You cannot do a plus or a minus also. So that is the amount of basics that we are going to use. So you won't have a problem. Statistics is going to be quite extensive. So in statistics, we have your mean median mode, suppose. You have your standard deviation, skewness, kurtosis, little bit of normal distribution and all, which is new to everybody, so you don't have to worry about it. And then we have the regression part. So statistics is going to be a little extensive. There are going to be 2-3 portions to it. So like say for example, I'm talking about mean and median. You might have done mean and median. You can calculate averages. You've done that in school. Doesn't matter. Now let me ask you a question. Suppose there is one stock and I'm giving you the 10 years return for that stock. It was 8%, 9%, 11%, 10%, 9%, 8%. I've got all these values and let's say one value is 80%. So there are 10 returns I've given you. The average return is going to be somewhere close to 18. Because these are all 10% on an average and I've given you one value of 80. If you divide all these value by 10, 80 divided by 10, 8% will be contributed extra by this one. So let's say the average is approximately 18%. But don't you think the returns are on an average 10% and 80% return is a deviation? Do you expect that the stock in the future is going to give you 18% return? No. We have to analyze as to why did it get an 80% return in one go, and the rest are all around 10% returns only. Mean will give you 18%, but if you calculate median, median will arrange all these values in an ascending order, and it will tell you the fifth value is, let's say, 10% or 11% or 9%. So basically, if you have extreme values in your data, your mean is going to be distorted, but your median will not be distorted, because even if I make this 80 or 800, your median remains the same. So this level of analysis and understanding will be needed when you're looking at content on mean, median, mode, standard deviation, variance. Why do you call a standard deviation standard deviation? What is so standard about it? Where do you get the formula as x minus x bar whole square, whatever the formula be? So we will get down to that level of analysis. So you will understand statistics very well. That is the only common overlap part when you're looking at class 11 and 12. But other than that, the stats part is totally new for you. So you don't have to worry about it. Right? So for those who are scared of maths, trust me, it will not be that big a problem. You just have to put in maybe 20% extra effort as compared to the others, but you'll be able to tackle it. When you're talking about probability, suppose, I'll just get back to it. Like when you want to make forecasts, when you want to make analysis for the future, don't you think probability is going to be used? 20% chances that this will happen, 30% probability is there that this will happen. So when you want to make forecasts and all, don't you think probability will come into use? Don't you think you have to analyze the past data in order to make forecasts for the future? There is going to be a section on regression where we need to probably form an equation like y is equal to, let's say y is equal to b0 plus b1x1 plus b2x2, etc. Let's say I want to form a relationship that SBI's return is equal to some 5 plus 3.2 into interest rate plus 5.1 into inflation minus 2.1 into unemployment rate. So basically, if I can make a forecast of how the interest rate, inflation, unemployment, etc. will be there in the future, I will be able to make a forecast about SBI's return. If I can make a forecast about interest rate, inflation and all, so I need to form an equation for that, right? I need to understand the relationship of SBI's return with respect to the other factors. So that needs to be captured in an equation. So this is your regression part. We'll have a few readings on regression. And then we'll do a few little complicated chapters like simulation or volatility and all. So how do you understand the volatility? So those things I'll not be able to explain right now. Only once we start with quants, I'll be able to get into those. So there will be 3-4 additional readings on that. Suppose seasonality. When you're talking about a car company, the car companies, automobile companies are going to be making a higher amount of sales in the quarter 3 when you compare all the 4 quarters. Because October, November, December, they will have all their Diwali offers and Christmas offers and New Year offers and all. Because the tax token of the car will get 1 year old. The tax token of a car, the taxes for a car is 5-year taxes in India we have, and that expires on the 31st of December. So because of that, the cars are given at a discount a year before, at the year end, calendar year end, not financial year end. So if I want to analyze the sales of the cars of an automobile company, I need to incorporate the seasonality factor that quarter 3 the sales are always higher. Are you understanding this part? So all those kind of analysis, forecasting, seasonality, testing, creation of models and all those things we'll do in quants. So only the mean, median, mode part or the probability part is something that can overlap with 11 and 12. The rest of it is going to be new, and we'll do anyways everything from scratch. There is no algebra or trigonometry or calculus or anything as such. Just basic applications of a couple of things here and there would be there. That should not be a problem. So personally, I would genuinely, you can rely on the fact that you would not have so much of an issue with quants. That's your quant subject. Then in the third subject and fourth subjects are going to be quite related. There will be a lot of overlap. You have financial markets and products, and you have valuation methodologies. So basically, there is something called derivatives that is going to be covered in both the books. There is going to be fixed income that is mostly over here and partially over here. What do you understand by derivatives? Now, say for example, you're scared there will be a fire in your factory and you will be losing a lot of, you'll be incurring a lot of losses. What you do is, you go for a fire insurance. I'm scared that I might fall ill and the hospital bill is going to be like skyrocketing. And in order to prevent that, I go for a Mediclaim, health insurance. Similarly, what if you're scared that in your office, suppose I'm a tire manufacturer. What if I'm scared that the rubber prices will go up, my margins will shrink? What if the onion prices are higher and restaurants cannot just change their menu card every day and just say that, you know, the prices will be higher? What if I'm scared of that? What if I'm an importer? I pay 64 rupees and I buy $1 worth of goods from outside and I sell it in India. Now what if that dollar prices becomes 68 from 64? I'll have to pay for the same $1 stuff that I'm buying from abroad. I'll have to pay 68 rupees now. My cost is increasing significantly. So the rupee dollar rate is going to be affecting anybody and everybody who's importing goods from India from outside. And you know, the Indian markets, there is a good chunk of Chinese imports that's happening. Just imagine every single small toy seller or you know, the smallest of the shopkeepers also are so much affected by the rupee dollar exchange rate changes. Right? So what do you do in that case? How do you manage this risk? Fire insurance, health insurance is fine, but how do you manage risk with respect to these things? Or let's say I'm scared, I want to take a loan after 6 months, I don't need the money now. But I'm scared that after 6 months the interest rates in the market will go up. How do I manage this risk? Derivatives is going to come into use. So derivatives is going to be extensively covered in book 3 and 4 both, because it's a very important tool to do risk management, because we are studying financial risk management. So derivatives becomes a very important chapter. So there are 4 different kinds of derivatives. You'll have 2 on 1 futures, 3 forwards, 1 swaps, and about 6 or 7 on options. So you've got about 10 to 12 readings, 12 or so readings on just options, on just derivatives. There are different kinds of derivatives, and to introduce derivatives I need 2-3 hours. So I'll not be able to get into more details on derivatives right now. But derivatives is very important and extremely interesting topic when you're looking at finance. Then fixed income. In FRM we do not do so much, we don't get into the equity valuations as such, but fixed income securities are going to be important. What do you understand by fixed income securities? When you're investing like a fixed deposit, debentures, bonds, when you're getting a fixed deposit or when you're buying a debenture, basically you put $100 in the bank or the bonds or the debentures and you get a fixed rate of 8%, suppose 8 for 10 years, and at the end of 10 years you will get back your 100. So that is a fixed income security because it is giving you a fixed income of 8%. When interest rate increases, are you happy or you're sad? You're actually going to be sad, because I have blocked my money at 8% for 10 years and now if the rate is becoming 9%, I'm still stuck with the 8% level. So how are the interest rates moving? How will the fixed income markets get affected? So all the interest rate related calculations and the fixed income related calculations, you'll have about 6 or 7 chapters or so, 7 readings or so on fixed income, primarily in the 4th book. So there is a lot of overlap, like you have 3 readings on options here and 3 readings on options here. So over here they are talking about the introduction of options, and here the valuation part of it. So valuation methods have got a lot of portions actually. There is a VAR portion, there is a fixed income portion, there is an options portion, and there is a few theory chapters portion and stress testing portion. I'll come to it, I'm explaining, I'm just trying to recollect. And financial markets product is primarily derivatives and a couple of MBS, corporate bond, little bit of fixed income related chapters. This is related to fixed income on real estate related securities. Again, I'll need a little time to explain this. If you're very interested, you can just watch the asset securitization video that's there on YouTube. You can just go to the playlist. I'll give you all the details of that. Anyways, I'll do it anyways. So no point going through it right now. So derivatives is going to be a major chunk in your financial markets and products. There will be readings like, say for example, country risk. Now since so much of globalization has happened, therefore there is a country risk that we need to study. We need to understand how to evaluate the risk of investing in a particular country. You must have heard that India's rating has gone up or down. So you know there are rating agencies who give ratings to companies. So suppose Reliance has got a rating, Tata has got a rating, one has got a AA rating, another one is not so good, got a A rating, another one even not so good, BBB rating. So these rating agencies kind of give a ranking or a rating of sorts. So we investors understand, okay, this bond is safe, this guy's got a good rating. This company, this bond is very, very unsafe, is very risky. Of course, if it is more risky, it should be giving me more return. So we'll study a lot of bonds and all of those things over here. We'll study about rating agencies over here. We'll study about country risk over here. In 2007-8, you've understood that the markets were in extremely volatile situations. It was not a normal bad. Bad is like my tire went off, or my tire got punctured. That is a normal bad. Very bad would be your tire got punctured, your policeman got you, like 20 different things happening absolutely on an extreme level, bad with you. I'm just giving an example. Stress testing. Because you know, in 2007-8, it was not a normal bad market, it was an extremely bad market. PNB scam was there. PNB defaulting. If PNB goes bankrupt, that is an extreme situation. Lehman Brothers went bankrupt. So 2007-8 was a stressful situation. We need to understand how to manage in stressful situations and whether we will be able to survive in those kind of stressful situations or not. So stress testing related, we've got a few readings. Value at risk I'll not be able to explain right now, but this is advanced level of risk measurement. How do you measure risk? So derivatives is used to tackle risk, and a lot of measurement of risk is going to be there. So financial markets and products is introducing you to what kind of derivatives is there, fixed income is there. So it's introducing you, rating agencies are there, country risk, and a lot of calculations are there. And there are going to be a few, like there are 3 readings over here: insurance company, banking, and hedge funds and mutual funds. So these are the different financial products that are available: insurance products, mutual funds, banking products, hedge funds and all. So it's giving an introduction over there. So this is primarily your part 1 content. When you're looking at part 2, okay, alright, just one more thing. 2 is going to be absolutely numerical, and 3 and 4 is going to be a mix of numerical and non-numerical content as well. When you're looking at part 2, we've got market risk, we've got credit risk, we've got operational risk, and we've got investment risk. So when you're looking at the level 2 curriculum, it is absolutely specializing in your risk part. If you're comparing, let's say for example the finance subject of CA, which is the equivalent of CPA, the Indian equivalent of CPA, or if you're comparing with respect to, let's say, a CFA or something, you will find overlaps over here with respect to derivatives, with respect to fixed income, a little bit in quants and a little bit in portfolio. But you will not have any overlap over here. And over here also you're getting into extreme details with respect to derivatives, fixed income, risk management and all of that. Anyways, coming to part 2, the curriculum is absolutely focused into your risk domain. So market risk, credit risk. Market risk, as I told you, if interest rate goes up or down, or if any of the market factors change, what is the risk? I'll not get into so much of details, because I'll not be able to explain without this background also. So I'll not be able to explain the details. Credit risk, again, it is more focused onto the banking sector. The credit risk, banking and financial institutions. So when I'm talking about financial institutions, investment banks, NBFCs, investment companies and all of that, because risk management becomes very important there. So credit risk is that the other party is not going to make the payments. So how do you calculate credit risk? Say for example, if there are 2 people who want to take a loan from me. So this person is more risky. So obviously I should charge more interest rate from this guy. So all those calculations and all those things comes into your credit risk. Now operational risk is going to be quite extensive actually. It's one of the most extensive subjects, if I would say. Liquidity risk is also included in this one itself. There is a good chunk of Basel norms over here. I was discussing in the beginning that the banks have to be, you're implementing Basel norms over here on the banks in order to make sure that they are working within permissible limits. So RBI, that is the central bank in India, will be applying the Basel norms to every bank over here in India. They will be regulating the banks in India. So Basel norms is covered under operational risk. A little irritating and theoretical content is also there in operational risk. So in the operations, what are risks? Fraud risk, threat, money laundering could happen. So that has become a major concern nowadays. Money laundering and so those things are going to be covered over here. This one is going to be focusing on the investment risk. So again, this is going to be more calculation centric, little more calculation centric and partially calculation centric. This is going to be more on the theoretical grounds, except for the Basel part. When you're looking at the investment risk, when we are making investments, hedge funds and different kinds of funds are making investments and all. So when you're making investments in the markets and all, how do you evaluate the risk over here? That is investment risk. And current issues I've already told you. Earlier we had the 7-8 crisis. Even before that we used to have, and I had given my exam, the case studies in the financial disaster chapter was actually there over here in current issues. And because it is current, it keeps on evolving. Every year the subject keeps on changing. So then we had the 7-8 crisis, bitcoins, algo trading, high frequency trading, negative interest rate. Now we've got the big data, data econometrics, data science, algorithmic, neural this thing, and artificial intelligence, and all of those things over here. So this is on the current issues side. So this is more or less your curriculum for FRM level 1 and level 2. Level 2, of course, I've given you in a very brief nutshell. You have an FRM 2 video also on YouTube, and when I do FRM level 2 curriculum with you, I will discuss that in the first class itself. So you need to have an understanding about this particular portion first. So this is your subject. It's about 69, 70 readings or so, and 80 readings over there. Comfortable till here?